Okay. Question on commission structure for selling businesses. Commissions are negotiable. It varies. I would say on average, it ranges 10 to 15% for smaller businesses. Let's see. Maybe selling a barber school in a retail strip.
Hi there.
How are you?
That's a mouthful.
Rashada?
I'm doing good. I just typed it because you were still talking about prospecting.
Yep.
And I didn't want to interrupt. So yeah, I might be selling a barber school that's in a retail strip that's owned by is owner occupied. So there's no lease on it. And the owner doesn't want to sell the building, just the business. Okay. And I want to know about how do I determine the sales price?
So how you determine the sales price is going to be based on his last 3 years of business tax returns, P&Ls, balance sheets, and his, we're early on in the year, so you're probably not going to, even if he gives you an interim P&L, it's not going to tell you all that much, but it will tell you if he's, it will tell you a little bit. So I usually get all the financials up front. If I understood you correctly, it sounds like he also owns the building. And if he's not paying himself rent, you're going to have to make an adjustment for that, because a negative adjustment for that, because anybody buying the business is going to be required to pay rent, right?
Yes.
Yeah. So you need to know what the market rent is going to be and incorporate that into your financial analysis. Ultimately, what you're looking to do is determine how much cash flow or how much money is available to the seller after all the operating expenses have been paid. So when we're doing a financial analysis or business price analysis, we're trying to determine operating income and operating expenses. And so a lot of business owners run all kinds of personal expenses through the business, which end up mitigating their taxes, and that's all well and good, but we want to be able to show a buyer the economic value of the business, meaning we want to stick with just operating income, operating expenses. So if they paid their kids' college tuition, we're going to add that back. That's not really an operating expense. It's not necessary for the successful operation of the business. Does that make sense?
Yes, totally.
Okay.
Thank you.
Yeah. So you start off with, the tax returns are typically what everybody wants to tie back to. So you start with the taxable income on the tax returns and then start adding discretionary expenses to that number to come up with the highest value that you can substantiate in what we call seller's discretionary earnings. And then there's a multiple that gets applied to that. And the multiple is going to vary depending on the seller discretionary earnings and the industry that it's in. So for most small businesses, let's say your seller's discretionary earnings was $60,000. That would be like a small micro business, right? So if this discretionary earnings is under $100,000, you're typically looking at maybe a 1 to 1.5 times multiple on that business. Because, and I should qualify that, also depends on where it's at. Because if it's here in California, it's going to be like a 1 to 1.5 times multiple. Other states where the cost of living is not so high, might be a little bit different. But
it's in Fort Worth.
It's in Fort Worth. Yeah. So I don't really know, your market as well, but I can tell you that, if once the SDE gets above 100 grand, then you're generally looking at maybe, a 2 times multiple, might be able to get up to a 3 times multiple if the SDE gets up to maybe 200, 250 in that range. So the higher the SDE goes, the higher your multiples go as well. And then there are other factors that can also affect the multiple, because really the business value in the eyes of a buyer is based on perceived risk. And so if you have other factors in the business that increase the risk, then the value is going to, even if it has higher SDE, the value is going to be affected negatively. And for example, I remember years ago, we were dealing with a set of dry cleaners, and there were like 3 locations. They had a plant and then 2 agencies. We're selling that. And it came out that basically there were 10 employees, but 4 of them did not have proper documentation to work legally in the United States, nor would they be able to provide that. So the buyer had the option of either continuing, hiring all the employees and continuing with that practice, which in California is the penalties are really exorbitant for that stuff if you get caught. The other alternative is replacing 40% of the staff immediately at close, once the transaction closed. And so in this particular case, a buyer decided he wasn't willing to do either one of those, and he walked from the deal. And that was when I learned that we needed to ask those questions up front. So,
Wow.
I mean, you learn all kinds of things in this business.
Yes, everything's a learning experience, definitely.
Every one of them. So, but yeah, definitely make sure when you're doing your financials, Rashada, that you make an adjustment for the rent, because that's going to be a critical piece. And that is going to affect your value. Okay.
Thank you.
Sure.